Investing could be really tricky, and if you are not careful, you could end up losing a lot of money. When I first started investing, I was doing pretty good, until I lost a lot of money because I didn't know some important things about investing. That's why I am going to show you the 5 things that I wish I had known before starting investing. Day trading is extremely risky, more than they tell you. We are all used to hear about traders in banks, TV series or movies that earn millions per year. That's why when we talk about investing, we immediately think about traders which pass their day in front of charts, analyzing every bit of information and price movement to get the best trade of the day. Because of that, you start studying technical analysis, you start to read every piece of financial news that you can find in order to be able to trade as it has been presented to you. And that's how I also started, carried by the hopes of earning a lot of money very rapidly. What I did not know is that in reality, around 90% of the day traders lose their money. Trading day by day is extremely demanding, physically and mentally, because you have to stay attentive to what is happening all the time, and this leads to fatigue and poor decision making, which also means making errors and losing a lot of money. It is very difficult to follow every news that could impact your investment or every price movement, and all of this is mostly unpredictable. You might have a news that you are sure is going to bring up the price of your stock or your investment, but in the end it might not. All of these make trading extremely risky and demanding. Very few actually manage to earn a lot of money out of it, but they also sacrifice a lot. That's why I would not advise to start with day trading. Commissions make the difference. While I was making my first trade, I was super happy. I knew about the spread between the sell and buy prices. However, I did not know the impact that it would have on my investment. As soon as I opened the position, I saw that it was already negative of 0.3% and I was extremely disappointed. The day after, I checked my account and I saw that it was even lower despite the price going a little up. I was like, what happened? Did I sell instead of buying? No, it was just the overnight fee that I had to pay for every night my position was open. While investing, you face many different fees. There are some that are very clear, but there are others that are very difficult to discover before actually paying them. And over the long run, these fees make a lot of difference, especially those that are applied continuously. For example, look at this graph. If you invest $10,000 for 10 years, with let's say 10% return per year, you're going to have almost $26,000. On the other side, if you had a commission of 1% per year, the average for a financial advisor, you would even have $24,000. That's a difference of more than $2,000. And that's only one type of commission, since you might have many more. What I'm trying to say is that commissions can add up and badly hurt your investments. So always try to search for brokers or banks that offer low commissions. Long-term investments make you pay less taxes. This is something that many investors, even with years of experience, might not know. And it is a very good news for those that invest for the long term, because the difference in taxation might be very high, depending on the country where you are. Normally, earnings from investments started and finished in the same year are added to your gross income and taxed according to the rate of your country. And this means that your taxation rate might increase because of your investments. On the other hand, long-term investments are treated completely different. They are not added to your gross income, and because of that, your tax rate is not going to increase. Their taxation is treated separately, and their rate is normally fixed. It depends on the country where you are, with some countries like Denmark at 42% and others like Switzerland at 0%. In general, most of the countries in the world have a taxation between 20% and 30%, which is normally much lower than the gross income taxation. And remember, you only pay taxes for the closed investments of the year and not for the open ones. This means that you might not even have to pay for taxes for your investments for many years. Let's take the same example from before. In the first case, you do yearly investments and every 31st of December you close the position and reopen it the 1st of January at the same price. Doing that and paying an average tax rate of 40% on it, you would finally earn almost $18,000. Pretty nice sum, but look what happens now to the green line. With a long-term investment, you would not pay the taxes as long as you don't close the position. And after 10 years, you would have close to $26,000. It is a difference of $8,000. The power of long-term investments is just enormous, and this is one of the reasons why. Do investments of at least 1 year and you'll easily benefit of this tax advantage. Leverage is more hell than heaven. Leverage is actually one of the main reasons for which people start to invest, but it also is the first reason for which people lose money. Let's see how it works. Imagine you have a lemonade stand and you want to make more money. Instead of using your own money to buy more lemons and sugar, you borrow money from your friend to buy more ingredients and make more lemonade to sell. If you sell all of the extra lemonade you made, you will have more money than if you had just used your own money to make the lemonade. This is like financial leverage because you were able to make more money by using someone else's money. However, the flip side is that if things don't go well and you don't sell as much lemonade as you thought, you might end up losing money because you still have to pay back the money you borrowed from your friend, even if you didn't make as much money as you planned. That's why leverage is a double-edged sword, with risks that are much higher than the rewards. However, when you start investing, you don't really understand this risk, and all the opportunities that it offers you put them in shadow. And all of this can end up in losing a lot of money and losing trust in investments. Emotions are your worst enemy in investments. Emotions might not be one of the first things you connect to investments, however, it is one of the most important ones. They can be very dangerous mixed with investments because they could lead to decisions which are not based on facts and logic. The classical example of that is when the stock market is going down and you are worried. You might sell all of your stocks in order to prevent further losses, but at the same time you are renouncing to all the future gains. For example, during COVID, the market has performed badly before going up even stronger than before. Those that controlled their fear have made incredible gains in this period. Those that didn't have lost even more. The same could be said when the market is going up and you buy stocks because you're happy and confident it will continue to go up. It is very dangerous to be emotional while investing, and it's vital to be able to separate your feelings from your money. For sure, it is not easy to manage this aspect when you start investing. But if you make the effort to not look at your investments every day and to think about this money as something that it is gone, after some time it will get easier and you will be able to separate investments and emotions. I hope these advices will help you and your investments, and if you enjoyed this video, leave a comment and put a like.